Thanks, Hamish, and good morning, everyone. It's good to finally get the first one out of the way. I'll be initiating on a few more stocks over the next few weeks and months, so hopefully look forward to getting up here and speaking to you guys more often with hopefully some good money making ideas for clients. So on Amcor, I think there's a press over. Yep. So on Amcor, we've got an ad recommendation, 15 to 52 target price. Key points on why we like it. Number one, Amcor is a high quality defensive business with growth from emerging markets. It's got a strong management team. It's got strong returns on funds employed of 19%, return on equity 24%, and 95% of the business is to defensive sectors. So think food and bev, healthcare, personal care, and tobacco packaging. So I think if you get volatility come back into the market over the next few months, I think this stock should be well supported if there is that flight to safety. Number two, it's got large international exposure. 95% of revenue is generated from outside Australia. It's roughly split, so 31% in the US, 34% in Europe, 30% in emerging markets. So I think if you're looking for a high quality company with exposure to international stable defensive markets that's already trading on the ASX, I think you should look at Amcor. Number three, it's got leading global market positions. So it operates in 43 countries, and it's number one in food flexibles, it's the number one in healthcare flexibles, number one in healthcare packaging, and number one in rigid plastic containers. And number four, and I think this is probably the biggest short-term catalyst for the stock at the moment, is the falling Australian dollar. Amcor reports in US dollars, and a falling Australian dollar is a tailwind for our valuation. On our numbers, a 1 cent fall in the Australian dollar is about a 0.5% increase to our valuation. There's a chart in the note. It's figure 1. It charts the Amcor share price versus the AUD USD, and it's quite interesting because it's almost perfectly negatively correlated. So I think if you're playing the falling Australian dollar theme, I think it's an interesting one that you can send to clients. Number 5, so it's had a great run, but I don't think the valuation is stretched. If you compare it to global peers, it's trading in line. If you compare it to Brambles, which is what we've done on this occasion, which is a little bit different, I think, to the rest of the market, they're very similar. They're both very similar companies. They're both defensive. They both report in US dollars. They both have a very small presence in Australia, and they both service the global FMCG customers. So if you compare the two on a PE, FY16 PE, Amcor's on 17.5 times, Brambles 21.5 times. Our target price for Amcor is based on 19 times earnings for FY16, so I still don't think it's expensive if you compare it to Brambles. And number 6, capital management. Capital management is always a potential with this company, so it generates a lot of cash, and it will return cash back to shareholders if it can't find acquisitions that meet its 20% return on investment hurdle. It's currently undertaking a $500 million buyback, which I think should continue to provide the support for the share price. And if you look back at the history of Amcor, they roughly do a buyback, say once every 4 or 5 years. So that should continue to support the share price also in the long term. On the main risks, obviously the rise in the Australian dollar is probably the biggest risk, but given the Fed's comments lately, the risk is probably to the downside rather than the upside. So Amcor does report in US dollars, and a third of earnings is from Europe, so it is exposed to that falling euro on the translation impact back to US dollars. Number 2, rising raw material prices. I think the risk is generally low anyway because Amcor does have pass-through mechanisms built in to their customer contracts, but the only real risk is there is a 1 to 3 month lag, so there will be a slight impact to earnings if in a rising raw material price environment. Number 3, bad weather. So Amcor is the biggest PET bottle manufacturer in the North America. So think your Coke bottles, your water bottles. So the risk is very minor, but drinks volumes do get impacted when when you get cooler summers or longer winters. But with anything that's weather related, these things tend to normalize over time anyway. And number 4, downturn in the US and Europe. European economies, given 2/3 of earnings come from US and Europe. So in summary, I think Amcor is a high quality defensive business with leverage to high growth emerging markets. It's got leverage to a falling Australian dollar, with 95% of earnings generated from outside Australia. I think provides good international diversification to client portfolios. Hence we initiate with an ad recommendation. So I might just leave it there. I'm happy to take any questions.